When people think of trading stocks and shares, their immediate thoughts are they buy now, sell almost immediately, make some profits, and the money lands in their account. Simply because they've seen a Forex trader on Instagram do it and they assume stocks and Forex are the same thing. But unfortunately, they are not. A lot of people jump into stocks expecting to be some fast-paced, high-leverage currency flip, only to realize the rules are completely different. And in this video, I'll be breaking down the difference between stocks and Forex, what they actually are, how you make money from them, including the hidden rules like the settlement time, ownership rights, and why treating one like the other could ruin your portfolio. Let's start with the basics because buying the two markets couldn't be more different. So what are stocks? When you buy a stock, you're buying a piece of a real company. You literally become part owner of the business. So if you buy shares in a bank or telecom, you're part owner of their assets, their equipment, and even their future profits. But for Forex, which stands for foreign exchange, you're not buying a real company, you're just flipping currencies. You're speculating on the relative strength of one nation's economy over the other. So if you buy Euro USD, you're simply betting that the Euro will gain value relative to the United States dollar. You own no physical assets, no business, and no equity. Now, the fact that they are different doesn't mean you don't make money from the two of them. Both of them can print you money real good. Matter of fact, Forex has large leverage compared to stocks. But the differences are things you should totally take note of, and you don't use the mentality of one to trade the other. So difference number one, settlement time. This is number one mistake that most Forex traders make when they cross over to stocks. In Forex, the moment you close a trade, the payout is almost instant. It hits your brokerage account and then it goes to your bank account if you hit the withdraw button. In stock market, we have what is called the settlement cycle. It used to be T+3, meaning the trading day plus 3 other working days. But right now, it is T+1 in the United States and many other countries. The reason for the settlement time is this. In Forex, you simply close a trade. But in stocks, you are selling your own unit of the company to some other person. Somebody must buy it from you. And the moment someone buys it, that T+1 is the time it takes for the SEC to transfer ownership of the company from the old owner to the new owner. And also within that time, money then change hands. That's when you hit your own brokerage account and you can then withdraw. This is why it's very important to look into liquidity of a company before you buy it, because if you buy a company with low liquidity and there's nobody ready to buy when you sell, you keep on holding on to that company until someone buys from you. And the more sales that a company has without so much of demand, it means that the company's stock price will keep on dropping. Difference number two, AGM, voting, and ownership rights. Because you're part owner of a company in the stock market, you get real shareholders' rights. So for example, you get invited to annual general meeting. This is where the chairman of the company and other board members come to discuss and tell their fellow shareholders what they have done with the company in the last 1 year that they have been on the board of the company. Their profits, their losses, their wins, and whatever they have done within that 1 year period. Also, you get to vote in the company's decision. For example, if a company's board was not doing well, there and then, people can raise vote of no confidence. You can ask the chairman questions, even the board members can be questioned in that meeting. But in Forex, you never get invited to the United States Central Bank because you simply traded the US dollar. You're purely speculating on price exchange rates. The AGMs used to be something I used to look up to as a kid, especially after my dad attended the annual general meeting for Cadbury Nigeria. At the time, he came in with some souvenirs. He came in with some cocoa drink, chocolate eclair, different things that they produce. So I asked him, did you buy all of this? He was like, no. It was given to every shareholder that attended. I got really excited because the next time he told me he was going for an annual general meeting, it was that of a bank. First bank to be precise. I was so excited. I wanted to see how much mint my daddy would bring home since that's what they deal in. Cash. At least to the best of my knowledge as a kid. So when he got home, I was excited. I wanted to see the mint. That smell. Only for him to tell me, well, they don't share money. I'm like, but that's what the company does now. They deal with money. And that was my very first lesson about owning companies. Sometimes they give you souvenirs of what they have. Other times they just give you random things like water bottle or a diary or something. And in some cases, they give nothing because some of them will fight. Sometimes to remove a board member, sometimes it's a vote of confidence on the chairman that is sitting. It's not always peaceful and it's not every time the company makes money. Difference number 3 is how you make money: dividend and price appreciation. So in Forex, there's only one way to win: price direction. You simply buy low and sell high. That's the only way to make money. If the price does not move in your favor, you make zero money. It either hits your stop loss or you end the trade yourself. In stocks, you have 2 ways to win. One is capital appreciation. So if a stock goes from $10 to $20, the value of your stock has simply increased by $10 for each unit of share of that company that you have. While for dividend, if a company earns profits, the board can then decide to pay part of those profits to the owners of the company. This can happen either quarterly, twice a year, or once a year. But then again, if the company makes profits and then they decide to reinvest into the company, it means you don't actually get some money. You just rely solely on growth. That's why you have growth stocks, dividend paying stocks, and the likes. Third is leverage and risk. Forex market has high leverage and high volatility. It is traded 24 hours a day, 5 days a week with massive liquidity. But brokers even give you high leverage, which is 1 to 100 leverage, 1 to 500 leverage, or even higher leverages. This means that $100 of your money can control $50,000 worth of currency. It sounds great until tiny 1% moves against you, and then it completely wipes out your entire account balance. That is margin call. In stock market, on the other hand, the leverage is low, the risk is also low. Say for example, you buy $100 worth of a stock. The stock price goes down by 5%. It does not affect the company or your stock itself. It simply has dropped in price. The company is still operating, making products or services, and generating revenue. Unless the company totally goes bankrupt, your position does not automatically get liquidated to zero, just like it is in Forex. So here's what we have discussed so far. On the stock market, you take ownership of real company, but Forex is just currency exchange. For cash settlement, stock is T+1, which is 1 business day. But in Forex, it is near instant. For income stream, in stock, you earn from dividend and price growth. In Forex, you earn from price direction only. For shareholders' rights, you get to attend AGMs, vote, and have board access in stocks. But in Forex, there is nothing. For trading hours, stock has its own trading hours. It is fixed, but Forex is 24 hours except on the weekend, where it doesn't trade at all. For leverage level, stock is typically low, but in Forex, extremely high. So which one exactly is right for you? If you want to build wealth over time with income generating assets, then stocks should totally be your thing. But if you want high frequency intraday price action and understand leverage risk management, Forex might just be your playground. Just don't mix the rules. If this cleared up any confusion and brought you some clarity, then you want to watch the next video on the corner of your screen. And don't forget, like and subscribe.